Hi, everyone, and welcome back to the Client Classroom. Today, we're talking about why bonds may matter more over the next decade than they have in previous years. So, for a long time, especially after the financial crisis, a lot of investors got used to thinking about bonds as the less exciting part of their portfolio. Low interest rates meant lower income, and so many people started relying more heavily on stocks for growth. But today, that environment looks a lot different. And one of the biggest shifts we're seeing right now is this. Bonds are likely to play a bigger role in portfolios over the next decade, not less. Now, the reason for that starts with something simple. Yields are higher again. After years of very low interest rates, investors today can earn more meaningful income from high-quality fixed income than they could just a few years ago. And that changes how bonds fit into a portfolio. So let me walk you through why this matters. First, bonds can provide income. One of the primary roles of fixed income has always been creating a predictable stream of cash flows. And that becomes especially important as investors move closer to retirement or begin thinking about how their portfolio will support their spending in the future. In a higher yield environment, bonds can once again contribute meaningfully to that income picture. Next, bonds can help with diversification. When markets become more volatile or economic growth slows, high-quality bonds have historically helped cushion equity declines. Now, they don't eliminate risk, but they can help provide a steady stream of income when portfolios get shaky. And that stability can make a big difference over time. Another important shift is flexibility. When yields were extremely low, investors often had to take more equity risk just to generate any sort of returns. Today, higher starting yields mean investors may be able to earn attractive returns without needing to rely as heavily on stocks as they once did. That's a meaningful change in how portfolios can be built going forward. Now, that said, not all bonds behave the same way. Going forward, a few things will matter more than they used to. Number one, duration. This is how sensitive bonds are to interest rate changes. Number two, credit quality. That's how strong the issuer is. And finally, number three, inflation, which affects real returns over time. Right now, many analysts are emphasizing the importance of staying selective and focusing on higher quality bonds rather than simply reaching for the highest yield available. Because higher yielding bonds sometimes mean higher risk, and those trade-offs matter. So when you step back and look at the bigger picture, fixed income probably won't just be the safe portion of your portfolio in the years ahead. It may become one of the most important building blocks for income, stability, and long-term diversification. If you'd like help reviewing how bonds fit into your portfolio today, especially in this new interest rate environment, we're always happy to help. You can schedule a time by visiting caserta-dejong.com or by giving us a call. Thanks for watching, and we'll see you next time in Client Classroom.